So I'm super thrilled to have Andy here today with us. Andy is the co-founder and the CEO of Wealthfront, and also the founder of Benchmark. Andy, thank you so much for joining us today, and welcome.
Thank you for inviting me.
So my first question to you is, could you give us one or two sentences about Wealthfront to make sure everybody knows what Wealthfront is?
Okay, it's a next generation banking service that helps young professionals manage their money for the short and the long term. We do this with a high yield cash account for the short term. We're about to add a full suite of checking account capabilities to that. And then we also have a best in class automated investment management service and automated financial planning as well.
Okay, thank you. When you started Wealthfront, what was the insight that you had?
Well, it's interesting. It started as a result of my involvement at Penn. I had retired from Benchmark in the beginning of 2005. And at that point, I joined the Penn Board of Trustees. One of my responsibilities as a trustee was to serve on the Endowment Investment Board, which I actually now chair. I'm a big believer that the premier university endowments are the best managed pools of capital in the world. One day, the investment team was taking the board through how they make their decisions on how to allocate their money and choose managers. And I knew that that the way that the Penn endowment team did it was the same way all the other Ivy League endowments do it, because friends of mine were on those boards. And it's different than the way individuals do it. And I was struck by how manual the process was, and how if you automated what they did in software, you could do an 80-20 on what they do, and thereby democratize access to sophisticated investment management.
Okay, and so what exactly was the insight you?
Well,
like
I knew about some trends that were going on in technology. I knew that brokerage firms had started to make available application programming interfaces to add value to their platforms. And I knew that the endowment method of investing was a superior method of investing, and I could put the two and two together. So being authentic to both worlds, the software world and the investment world, I saw an opportunity to marry them to make high quality investing available to the masses. Believe it or not, that was an insight.
Yeah, no. It's funny when you look back at technologies, and now they seem like the average technology, but a few years ago they were really like something different, like something unique. So my question is, was this insight a non-consensus insight?
Absolutely, because if you asked 10 people on the street, would you like software to manage your investments? I would doubt more than one would say yes.
And so did you ever, well, first of all, could you tell us about your framework about making money, how important it is to have a non-consensus insight?
Idea?
Yes.
Well, actually, it's not my idea. It's an insight from another phenomenal Penn graduate named Howard Marks, who's my investment idol. Howard was the founder of a famous distressed debt firm called Oaktree Capital, and he's as well known for his quarterly letter to his investors as he is his fantastic returns. All of his letters, which are fascinating, are built on the same foundation, and that is a belief that the only way that you make money is by being right in non-consensus. So the basic framework is a 2x2 matrix. On one dimension, you can be right or wrong. And on the other dimension, you can be consensus or non-consensus. Now, obviously, if you're wrong, you don't make money. But what most people don't realize is that if you're right in consensus, you don't make money because it's too easy. It's too obvious. The returns get arbitraged away. So the only way you make outsized returns as an investor, and I believe also as an entrepreneur, is if you're non-consensus and you end up being right. When you start out, you don't know you're right, you just know that you're non-consensus.
Yeah, no, that makes sense. And how do you, like as a startup, how do you test for this? Like, do you go, is it that you get the reactions, like some people say, oh, I love this idea, no, this won't happen, this is like very polar opposite feedback? Or how do you know that you have a non-consensus idea?
I'm going to tell you something very counterintuitive, and that is actually in the first class, in the first session of my class on product market fit at Stanford Graduate School of Business, where I've been teaching for 15 years, I teach, the subject is, should everyone like your idea? And the answer is absolutely not. Because the only reason that someone would like your idea is they've been conditioned to like it. And if they've been conditioned to like it, it means that other people are doing it. So I've actually reduced the entire course down to one question. And that is, what do you uniquely offer that people desperately want? If they're not desperate, they're not going to buy from you, because if there's a good enough alternative from a well-known and trusted vendor, people are going to go with a good enough alternative. Better doesn't matter. It's a big, big misperception that you win by delivering something better. In technology, you can almost never come from behind with a better product. You have to serve a different market.
Okay, that makes sense. So Wealthfront started off as a marketplace for selecting investment manager, and then you pivoted towards becoming a robo-advisor for investment. So my first question is, what is a pivot?
Well, a pivot is when you iterate on the market. I'm a very big believer in a philosophy, a methodology to pursue new ideas that was created by Steve Blank, who's a friend of mine. I think Steve revolutionized entrepreneurship with his customer development philosophy. You can read about it in a book called 4 Steps to the Epiphany. Eric Ries actually made it even more popular with his book, The Lean Startup. I think of the Lean Startup as the New Testament and 4 Steps to the Epiphany as the Old Testament. Eric basically made it more consumable and easier to understand. So the two of them, who are good friends, basically applied the scientific method to business. Believe it or not, prior to Steve promoting this methodology, no one ever applied the scientific method that we learn in 3rd grade and have to do a presentation on to business. The idea being that you create a hypothesis and then you run experiments to test that hypothesis. So Steve and Eric basically designed a system where you have to create 2 types of hypotheses. One is a value hypothesis and the other is a growth hypothesis. And you need to do them in order. You shouldn't do your growth hypothesis, which is the way to cost effectively acquire customers, until you've proven your value hypothesis. The value hypothesis consists of the what, the who, and the how. What are you going to build? For whom is it relevant? And what's the business model? That's the how that you deliver the product. Now, contrary to what most people think, you don't iterate on the what, you iterate on the who. Now, this is true in technology. I can't tell you about non-technology businesses because I have no experience in my career outside of technology. But unlike what you might read in entrepreneurship books, great companies, the companies that are the most well-known franchise tech companies, did not start as a result of an entrepreneur analyzing a market, looking for a problem and solving that problem. It was the opposite. They actually observed an inflection point in technology, saw that they could build a product based on that inflection point, and then they had to figure out what market wanted that product. So you keep iterating on the market, you don't iterate on the product. Now, that really limits the number of people who can be successful entrepreneurs because you have to be able to recognize an inflection point in technology. Without change, there is seldom opportunity. Now, in a professional services business, that you can succeed at due to execution, but not a technology business.
Okay, and that's why the insight is so important, to have the right insight.
Now, by the way, the original insight, the original value hypothesis is almost always wrong. Now, every great company has revised history. So part of the reason why we all think that entrepreneurs started with the market and found the product is that after they iterated into something that succeeded, they rewrote history to make it sound like that's what they did, because consumers prefer buying from companies who always intended to serve them. It just makes them feel more comfortable. So they all revise history. If I told you the stories behind Google and Apple and Netflix, it's completely different than what stories they tell.
Yeah, no, that's totally makes sense, because we all want to feel special, right? So going back to Wealthfront, so why did you pivot?
Because we were failing. Because our value hypothesis was wrong. And by the way, you're almost always wrong. There's one of our engineers, when we were going through our pivot, put a poster up all over our office, which was pretty small, but he basically took a children's book cover, which is a very famous children's book called Everyone Poops, and he changed it to Everyone Pivots. And so basically we had 10 months of cash left, and we were not growing exponentially. I think that the best measure of a consumer internet company's product market fit is whether or not it grows exponentially organically. If you grow through advertising, that is not valuable growth, because you might acquire customers who don't stay, and they're unlikely to recommend others. The only way that you get exponential organic growth is through word of mouth, and you only get word of mouth through delight, and you only get delight through product market fit. So the premier venture capitalists are riveted on exponential organic growth and could not care less about paid growth.
Yeah, no, it makes sense. Even though we see a lot of companies paying for their growth, right?
So you can fake it.
Yes.
You fake it till you make it. You fake it till you make it. And hopefully if you fake it well enough, you're going to attract some stupid investors who will give you the money, at which point you try to figure it out.
Yeah. Very true. So how did you make this pivot?
What do you mean by how did we make it?
So how did you decide that this was the next thing that you should pivot towards becoming a robo-advisor?
Well, as I said, we were failing. We were, I don't know, about a year, let's see, at a year and a half from the point we had shipped our service, this marketplace of investment managers. You could choose to manage the public equity portion of your portfolio, which should generally only be about a third of your portfolio. We had doubled from 15 to 30 million of assets under management. But we only had 10 months of cash left, as I said before. And even though we had doubled in the last 6 months, that rate of growth was not, if you extrapolated it, you could never get to a big business. It just really wasn't likely. Now, for the past 6 or 9 months, I had been asking people in our company to reach out to people who had chosen not to open an account with us. And I couldn't ever get anyone to do it. I couldn't get our VP of marketing to do it. I couldn't get my co-founder to do it. And I was a first-time CEO, and I'm a big believer, and I teach empowering others as a critical part of leadership. And I thought it would be terribly disempowering if I did it myself. But after 9 months of failing to get other people to do it, because this is quite ironic that young people don't like talking to others. This is the basis of Wealthfront's success, that we serve people who tell us that we pay you not to talk to us. But when it comes to figuring out your product market fit, you have to talk to people. And our employees wanted to look at behavioral data and they wanted to email people. They didn't want to talk to anyone. You can't find the surprise. What I learned from Scott Cook, the founder of Intuit, was that whenever you ship a new product, there's always a surprise. And what he learned is it's all the value lies in that surprise, that you should drop everything you're doing and double down on whatever that surprise was. So I reached out to about 100 people. I got 30 or 40 to actually engage with me. And these were people who had started the sign-up process and didn't complete. And I very politely told them that I was the co-founder of the company, and I would very much like to understand why they chose not to go ahead after they had started the process. And they gave me a very consistent message. They all basically said, and they all used different words, but it was all the same message. I'd rather that you manage all of my money adequately and inexpensively than a portion of it superbly. And the consistency of the message was really quite surprising. And it actually hit a nerve for me and my co-founder, who started doing the calls after I shared with him the early feedback, because we would go on press tours to promote Wealthfront. And we would often get asked by a reporter who was really enthusiastic about what we were doing, and do you manage my bonds too? And we would say no, and they'd say, oh. They were always disappointed. So it was very consistent with this feedback we were getting. And so we thought, well, that's a lot easier to do than what we were doing. And it only required a change to about 10% of our software. And while it appeared like we changed the product, it was a very small change to the product. It was a very big change to the market.
Okay. And then who did you go after at that point?
Delegators, young people who were delegators. So initially we thought about delegators, and then we had a board meeting right before we launched. We were going from beta to a general availability. And I said to our board, you know, the people that we show this to really like it. But our biggest challenge is the classic chicken and egg faced by the investment management industry. And that is that people don't know how to evaluate investment managers. So they use the only proxy available to them, which is assets under management, thinking that a manager that has more assets under management must be better than someone who has fewer assets under management. Nothing could be further from the truth. It has absolutely nothing to do with investment skill and everything to do with sales skill. So my challenge was, how do you attract assets if you don't have any assets? How do you get off the ground? And one of our investors gave us literally the critical insight in our business. And that was to apply something from the book Crossing the Chasm, which is a big part of what I teach, but I hadn't paid attention to it. And that is to focus on a very small niche as the beachhead, and then you expand into adjacent markets from the beachhead. So he said, why don't you focus on young people in tech? They will care a lot more about the quality of the user experience and your background than they will the assets under management. So the first thing that we did was I called up some former students of mine who were senior executives at Facebook, thinking that there's no one better connected than the people at Facebook, because A, they work at a social network company, and B, they use the social network more than anybody else. And I said, could you guys set me up for a seminar for Facebook employees, something that doesn't scale, but it can get you started. And we ran a few seminars where we didn't sell, we just educated people about best practices in investing. And it immediately took off with the engineers at Facebook. And then they were the influencers. So they told their friends who were the product managers and the business development people at Facebook. And then we expanded from them to their friends who worked in similar jobs at other tech companies. And then it expanded to their friends who they went to school with who worked in other professions. And then it expanded geographically. So that's how we were able to succeed, by really embracing the technology adoption lifecycle methodology from Jeffrey Moore.
Yes. And you touched on this a bit before, but so I guess when you saw exponential growth, you knew that you hit product market fit.
Correct.
And could you talk a bit about, so for consumer and also for enterprise businesses? So for consumer, you said exponential growth, but what about?
That's organic growth. Yeah, it has to be organic.
Sorry, organic, not paid.
So for enterprise companies, there are two different heuristics that I recommend. Number one is a trick that I learned from Doug Leone, who's the managing partner at Sequoia Capital. And he learned it from the person who actually truly invented product market fit. I named it, but the concept was really created by Don Valentine, the founder of Sequoia Capital. He passed away a few months ago, but he was a titan in the technology world. Don had a philosophy that if a startup could screw something up, it would, because we're just so under-resourced. And so the only way a startup can succeed is if the pull of the market is so great that it overcomes your ineptitude. And so he looked for companies who had an unbelievable pull from the market. So Doug, who had been a very accomplished salesperson before he became a venture capitalist, taught me that in an enterprise company, you always have to start with a proof of concept. In the early days, people don't trust that your product's going to do what's represented. So you have to start with a trial. Now, almost every company, to qualify its customers, says, I'll only do a trial with you if you sign a contract that says if after 30 days of use, if the product does what's represented, you'll buy it. And everyone signs this agreement. No one lives up to it. Usually takes 2 or 3 weeks to get the product installed. It's just not a priority. And so what Doug does is he pulls the trial after 30 days. If the company screams and pays you, you know you have product market fit. If they say, okay, they were never going to buy anyway. But almost every founder I know always says, give me more time. You know, the customer needs more time to recognize whether or not they need this. But if you go back to my point that only the desperate are going to buy your product when you're first starting out, if they're desperate, they're going to buy even if you pull the product. If they're not desperate, they were never going to buy it anyway. So that's number one, pull the trial. Number two, I learned from one of my teaching partners, Mark Leslie, who founded a very successful company called Veritas Software that he grew from 0 to about $1.5 billion in revenue before he retired. Now, Mark wrote an incredible article that I encourage you all to read called The Sales Learning Curve that he published in Harvard Business Review along with a professor at Stanford named Chuck Holloway. And basically, Mark and Chuck drew an analogy between the learning curve of sales and the learning curve of manufacturing. In business school, we always learn about a learning curve for manufacturing, but we never learn about one for sales. And what Mark and Chuck observed was that every company, when it's getting started, has a learning curve. And the sales take off, if they do, in an S curve. So they start out very, very slow. Then all of a sudden, they ramp quickly. And then the growth starts to slow down, but the company continues to grow. So you can think of it as two knees of the curve. And what Mark found was that it's not until you find the recipe that things take off. And coincidentally, that knee of the curve happens when the sales yield is greater than 1. So if you draw this S curve on an XY axis, if the x-axis is time, the y-axis is sales yield. Now, the numerator in sales yield is the contribution margin of your average sales team, and the denominator is the total cost to field the team. So imagine if a sales team generates $1 million of revenue per year, and the gross margin is 70%, then that's a $700,000 contribution margin. And a typical direct salesperson might cost something on the order of 250 to 300,000 fully burdened with commission and benefits and all. They usually have a sales engineer. That person probably is fully burdened, costs about $200,000. They usually have a portion of an inside sales rep to do prospecting, and they have overhead that's amortized. So all told, the cost of a sales team is on the order of $600,000. So in order to get a sales yield greater than 1, that team has to generate a contribution margin greater than $600,000. Until a sales team can generate a sales yield greater than 1, you don't have product market fit. And once you get past 1, it explodes. It's really quite amazing. And that was a phenomenal observation that I've seen work over and over again. And perhaps the biggest waste of money in an enterprise startup is ramping the sales force before you know whether or not the sales yield is greater than 1. So what Mark and Chuck argue is you should only hire 1 sales rep to prove the sales yield and then ramp the sales force.
Yeah, that makes sense. It's
because
sort of
first to market is irrelevant, by the way. First to product market fit matters. And so you don't need to ramp the sales force to get to product market fit faster.
Yeah. No, it's the same thing as if you don't have the value, if you start the growth before the value is proven,
That's
you're
why
just
you shouldn't
spending money.
Exactly. So that's why you shouldn't pursue your growth hypothesis until after you've proven your value hypothesis.
Yeah. And thank you for that. So Wealthfront have now evolved from a robo-advisor to a banking service. Why this, why evolve from, from the robo-advisor to the banking service?
Well, we were going through an exercise about 1.5 years ago where we really wanted to simplify our vision. It's really important to be able to simply state your mission, your vision, your strategy, and your tactics. I know we learned this in business school, but it's really, it's a really important leadership tool to be able to get that context across to all of your employees, especially as you get bigger and bigger. And it struck me that our great strength was in software, which is very different from a classic fintech company. Most fintech companies are big on the fin and little on the tech. They're really marketing companies with a thin layer of software. We're the opposite. We're little, thin, big tech. We want to win through product. So I was trying to really get the vision statement down into 1 sentence. And I ultimately came up with, based on the things that we had developed, we want to optimize and automate all of your finances. We were doing it for investing, but we saw an opportunity to do it for all of your finances. Now, what we meant by that, and then one of our engineers came up with this phenomenal further simplification of self-driving money. And what we meant by that was we wanted to enable our customers to direct deposit their paycheck with us. We would automatically pay their bills and then route the remaining money to their most appropriate account, depending on their situation and goals, which we know through all of their account linking. We make it really easy for you to link up electronically all of your accounts. And from that, we're able to provide better advice than any traditional financial advisor. So in order to do that, we needed a repository into which you direct deposit. We created a very simple product. So we started with an MVP to try to find product market fit. And we were quite amazed that in our first 12 months, we attracted $8 billion of deposits by offering a really simple to use high yield cash account. And then very quickly thereafter, we realized it took off so quickly that, again, savoring surprise, we said, you know what, we should lead with banking rather than investing because it hit a bigger nerve than investing did. And that's why it's really important for an entrepreneur to be humble and objective, because the market knows more than you do. Anyone who tells me that they have a vision of the future is completely full of it. That the market knows, and what you have to do is try to tap into the market to figure that out. And so this month, we'll actually introduce a full suite of checking features on top of that high yield cash account. And then shortly thereafter, we'll introduce the first of our automated self-driving money features. So what we've learned is we acquire customers at a much more rapid and cheap rate by leading with banking than we do by leading with investing. But I never could have told you that in advance.
Yeah, no, exactly. Yeah, no, the market knows best. So I'm going to pass it over to Shilpa for some question from our audience from this section.
So thanks, Andy. Along those lines, we had a question from Kunal Malhotra. He says, every company that started as a robo app, a trading app, or a lending app is converging to what a bank has always been, a one-stop shop for all your financial services. Where do you think this will go? And are we just going to see the top 5 banks replaced by the top 5 new age fintechs?
Well, this is not something new. First of all, I completely agree with Kunal's observation. And interestingly, it happens every 20 years. So 40 years ago, Merrill Lynch introduced something they called the cash management account, which was the first time you could combine banking and investing. It allowed you to write checks on a money market account. And this is what propelled Merrill Lynch into the lead among all of the traditional brokerage firms. 20 years ago, Charles Schwab introduced the first free ATM on top of an investment account. And most people don't realize this, but today Schwab is a bank. It's not an investment firm. 70% of their revenues come from banking. As a matter of fact, when we pivoted into what we do now 8 years ago at Wealthfront, Chuck Schwab said to me, you ought to be a bank. It's a much better way to monetize. So here we are 20 years hence, and now the innovation isn't a check on a money market fund or a free ATM, it's software. Software has evolved to the point that we can deliver, we can become the financial hub. So the challenge is, who's going to deliver the value? Who's going to be able to optimize and automate everything that you do? And who do you trust? There are no competitors of ours that come close to the average account size that we offer. And I think that's a proxy for trust.
Cool.
I couldn't have paid you to ask me a better question. Thank you very much.
Cool, thanks, Kunal. So our next question is along the lines of a question that a lot of people have asked. So there's many options for online investing: Fidelity, Schwab, E-Trade, Robinhood, Betterment. How do you go about convincing customers that you are different and that you'll generate better returns than other options?
Well,
and
first,
people want to understand, how do you go about creating your competition and creating a competitive advantage?
Well, the competitive advantage is the software. The way that we try to convince people is by being candid and transparent. We think, A, that builds trust. And if we delight our customers, they tell other people about it. Now, truth be told, offering a diversified and rebalanced portfolio of low-cost index funds is an absolute commodity. That's what we started with 8 years ago. And I used to tell people when we started, we had very little value in price accordingly. That used to drive my colleagues at Wealthfront nuts, but we really didn't add much value at all. And all of the robo-advisors are going to generate approximately the same pre-tax return. There's going to be almost no difference. We're each going to have slightly different asset allocations, but honestly, luck plays a role in which one is going to do better. And the fact that we do better over 6 months is no indication that we're a better service. One shouldn't look at it that way. But the way one should look at it is, who's going to generate the best after-tax net of fee returns? And no one can approach us on the after-tax measure. So we created a capability. We were the first to deliver something called tax loss harvesting. Others have, a couple of others have created it, but if you actually benchmark them, someone like Betterment only generates about 60% of the harvested losses we do. Schwab generates about 5% of the harvested losses that we do. And then we went one step further. So at first we harvested at the asset class level among ETFs. We recruited the gentleman who invented the index fund, Bert Malkiel, to be our chief investment officer. Amy Gutman, our university president, actually introduced me because before she came to Penn, she was the provost at Princeton and Bert is an emeritus professor at Princeton. And so Bert said, you know, there's more juice to be squeezed out of the lemon if we harvest within an index. So we created something called stock level tax loss harvesting. Nobody does that. And then we added even more value by adding a capability that when you transfer securities to us, we don't immediately sell them to put them into our portfolio. What we do is we look at the tax, at the gain, and whether it's short-term or long-term, and we're intelligent about when we sell to minimize the gains that you might have. Again, nobody does that. So while it appears that we're all the same, there's a radical difference under the cover. And if you're willing to take the time to read the materials that we publish, you'll see that. But you're usually not willing to do that. So you rely on your friends who did.
Cool, thank you. And we have one last question. This one was highly voted. What are the leading indicators of product market fit, and what are some effective ways to validate widely different value hypotheses?
As I said, with a consumer company, it's exponential organic growth. And for an enterprise company, it's pulling the trial and a sales yield greater than 1. There are no alternatives to those. I've seen one that's been promoted lately about if 40% or 60% of people surveyed said that they would be upset if you took the product away from them, that's an indication. And to me, that's no indication at all, because the people who used our marketplace service loved it. That was not an indication of product market fit because there weren't very many of them.
With that, I'll hand it back to Kara for the next section. Thanks.
Okay, thank you. So my next question is, why do so many people struggle with their personal finances?
I think confidence or lack thereof is the big issue. Where very few people learn about finance. It's not a subject that's taught at the high school or university level. And especially if you're intelligent, you might be embarrassed to ask about it because it might indicate that you're less intelligent if you don't know anything about it. So I think the biggest driver of it is lack of confidence. You know, there's some really interesting research that shows that women are much better investors than men, but they also are more lacking in confidence about what they do.
Okay, yeah. I guess women are less risk takers. Could that be one of the reasons?
The hypothesis that I've seen shared from the research is that they're more willing to commit to their strategy. That they don't think they can outsmart the market.
Yes, that's a good.
And the research is very clear that trading and security selection leads to worse outcomes.
Yes. So why aren't the current banking services, why are they failing their customers?
Because they prioritize making money from you over with you. And everyone feels it. Look at what happened with Wells Fargo. I mean, that was a really gross example. But recently, Jamie Dimon, who's a phenomenal bank CEO, was asked after the second Fed rate cut This was before the 2 rate cuts in March. What is JP Morgan Chase likely to do if the Fed cuts further? And he, without hesitating, he said, increase fees. And
Yeah.
by the way, the folks at JP Morgan were really pissed off with us for pointing that out. He said it. It wasn't I who said it, it was he. And so this problem, this prioritizing your stockholders over your customers, is something that is endemic to the financial services world that is not endemic to the tech world.
Yeah. So what do you think the future of banking would look like?
Well, today, if you think about it, a mobile banking app is just an ATM in your pocket. There's been very little advancement in the capabilities of what you do in software, even though the device on which the software runs is hundreds of times more powerful than computers of the past. So I'm a big believer that companies that take advantage of the financial data that is available and draw inferences from that data in order to make your life simpler, more convenient, and less expensive are likely to do very well. That's what we're trying to do.
And so how do you think the future of banking would help people during this crisis?
I don't think it's going to help that much, because if you've lost your job, you've lost your income, there's not much someone can do for you. It can help you prepare in advance of a crisis like this. For example, we've been recommending since our founding that people first put their money in an emergency fund, and that emergency fund should be at least 3 or 6 months of your living expenses. Now, when we gave that recommendation, that meant we were telling people not to give us money. Do you know any financial institution that does that? And we have consistently said that. So part of our self-driving money motivation is to make sure that we deliver the tools that would do that automatically for you, so that you would have done the right thing in advance of the crisis. Once the crisis hits, I'm not sure there's that much we can do. But preparing for the next one is something that we can do a really good job for.
Yeah, no, I think that would be very helpful for everybody. And so do you think that your banking, that the real disruption that you're doing at Wealthfront, is that the banking or the investment? So
you hit a pet peeve of mine, Karos. One of the things that I teach, or part of the product market fit class, is a big section on disruption. Unfortunately, disruption is the most misused term in technology. It was actually coined by a professor at Harvard Business School named Clay Christensen, who just passed away. And Clay had a precise definition of it. And whenever I hear disruption, I think about that versus changing things around. Yeah. So for Christensen, disruption meant delivering something that's simpler, cheaper, and more convenient than the incumbent in a way that is uneconomic for the incumbent to address. Now, there are 2 types of disruptions. One is a new market disruption, and the other one is a low-end disruption. So a new market disruption is delivering services to non-consumers, people who could not previously use someone's service. Classic example, eBay versus Sotheby's. Sotheby's business model was designed to sell things at $20,000 and above. They weren't going to enable someone to sell something for $10 out of their garage. That was a new market disruption. A low-end disruption is when you address people who are overserved with something that's simpler, cheaper, and more convenient. A great example of that is what Amazon did with books, or what what Dell did with computers. Because they started with a clean sheet of paper, they were competing with Compaq. Compaq made a 40% or 45% gross margin selling to resellers. Resellers made a 20% gross margin selling to end users. Dell sold directly to end users at a 25% gross margin. That means they sold to end users at a lower price than the retailers were able to buy. If Compaq tried to address that and go direct, it would have pissed off their channel. As a public company, if they lost their channel, their stock would have plummeted. So they would have been hurt if they tried to go after the disruptor. If they ignored the disruptor, as they did, the disruptor keeps getting better and kills them later. That's why Clay named his first book, The Innovator's Dilemma. You're damned if you do and you're damned if you don't, if a company is truly disruptive. Our business model, we think, is simpler, cheaper, and more convenient and uneconomic for the incumbent to address. And we're a new market disruption. We're trying to serve people that the banks don't serve very well. The investment firms first and then the banks. And that's young people who don't want to talk to someone.
Yeah, and I have one other question. So if we go back to crossing the chasm, now are you, with this banking product, are you now in like trying to cross the chasm by
For banking, I think we crossed the chasm on the investment side. We're with early adopters on the banking product.
Okay.
The idea, because we're promoting something that's never been done before, and that is an all-in-one account that has the features, the best features of a savings account and a checking account. If you think about it, why do you need separate accounts? It's a regulatory and ancient construct. There's no need to have separate accounts that you have to manage. So that's a new concept that we have to convince early adopters to use before we can get the references to cross the chasm to serve the people in the early majority.
Yes. Okay, that makes sense. Because it's more about the technologies than the companies, right? When you're dealing with crossing chasm, he talks about technology trends, right? So you did one technology trends about the investment, and now you're doing the banking.
Yes.
Okay, so I'm going to pass it over to Shilpa for some more questions.
Sure. So this question is from Henry. What are your thoughts on new technology, programmable money powered by blockchain and smart contract? Will this potentially disrupt the financial services industry, including the products that you're developing?
Well, this is going to be an unpopular thing, but I think blockchain is complete bullshit. I think it was a critical enabler of cryptocurrency, but you have to think, in order to understand my point, in order to make my point, I think it's best to explain it with a little bit of description about applications versus platforms. Blockchain's a platform. If you actually look back in history, very, 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 very few companies succeeded by building a platform and encouraging people to come build on top of that platform. It's really hard to get traction. Whereas the companies that ultimately succeeded with a platform started with an application, and then they opened it up for people to build value on top of it. You can think about Facebook as an application, and then people built on top of it. You can think about eBay as an application, or Amazon. They were just a bookseller, and then they sold some other things. Then they enabled third parties to sell on top of their platform. But if they attempted to build the platform from the get-go, they were very unlikely to have gotten any traction. So it just so happens that blockchain was a great enabler for cryptocurrencies, but blockchain is just a distributed database. And it actually is a much more expensive way to build a distributed database if you were starting with a clean sheet of paper. So I think blockchain is much ado about nothing.
All right, thank you for that. This other question, in your opinion, what do we need to do differently as a society to raise the participation rate in investing? The investor class is a narrow segment, or seems to be a narrow segment of the population.
Well, first we have to lower the minimums. And that was a critical thing that we attempted to do at Wealthfront. Prior to our entry in the market, a financial advisor typically had a minimum of $1 million. So that meant that in order to get access to a pretty good level of expertise, you needed $1 million. Our initial minimum was $5,000. And we thought that was a way to radically lower the minimum. We didn't want to go lower because I had a hypothesis that if you can't save $5,000, you can't save at all. It's a sad point of view, but that was my hypothesis. Well, after a couple of years, there were a number of competitors who had lower minimums. And so we decided, okay, let's try lowering our minimum to $500. And sadly, my hypothesis was correct, that people who can only afford to save $500, the second the market goes down, they pull their money because it's too dear to them. They're not able to just leave it there. So unfortunately, investing is really only appropriate for people who are willing to set their money aside for at least 3 to 5 years. Bad things happen when you take a shorter term outlook. There's been a lot of research done that has shown that individual investors buy when the market goes up and sell when the market goes down. And that costs them on average about 3% of their return every year. Unless there's education at an earlier age, I don't see that changing. But we feel really proud of the fact that we radically lowered the minimum for absolutely fantastic quality investing.
Great, thank you. And this last question was highly voted. What has been the biggest challenge to growing the business in terms of your clients and internal team? What are some of your biggest worries, potential disruptions that are keeping you up at night with regards to your business?
Well, again, a disruption is a product that's simpler, cheaper, more convenient, that's uneconomic for us to address. Fortunately, by keeping our prices really low and our minimums really low, we have, I think, provided some defense against that. So I haven't seen an innovator's dilemma for us. What I think a lot about is recruiting engineers. Over half of our company are engineers. That's really unusual for a consumer internet company. And it speaks to our focus on winning through product, because delight is the greatest form of virality. We grow through word of mouth. We don't grow through advertising. As an example, Betterment is smaller than we are, but they've spent $120 million more than we have on advertising, and almost all of that on advertising. So in order for us to deliver all the features we want, we have sort of an insatiable demand for high quality engineers, and that's what keeps me up at night.
Great, thanks, Andy. Back to you, Caro.
Okay, so now we're going to move over to the crisis or our current environment. So it's a very emotional time for everybody. And with the ability to constantly check your portfolio, how do you make sure that your customers are making rational decisions?
We're incredibly fortunate that our customers behave differently. Now, a number of us have different hypotheses within the company. I'm not sure which one is correct. I heard a reporter once told me, you don't talk them onto the ledge, so you don't have to talk them off the ledge, which, by the way, has always been one of the biggest arguments for why you need financial advisors, that it has not proven to be true. Now, in our 8 years, we have faced 8 market corrections and now 2 bear markets. And interestingly, throughout all of those events, we've never seen any correlation between withdrawals and the market. Perhaps it's because people buy into passive investing. And if you buy into passive investing, you know that you should just leave your money invested and let it compound. But we have seen very few withdrawals. Our withdrawals are much more a function, because of the age of our customers, of the need to buy a home or buying a car or paying for a wedding, as opposed to timing the market. Now, to be honest, the way we do see this bad behavior is add-on deposits. Because our clients are in the wealth generation phase of their lives, not the wealth preservation phase. They're typically 25 to 40 years old and an average age of 32. They keep adding to their account year in and year out. But when we find that when markets are really volatile, people hit the brakes on the add-on deposits, which is the worst thing they can do. But fortunately, they don't withdraw.
Okay, so let's go to the next question about like what are the do's and the don'ts in this environment, both for personal finance and also for investment.
Well, environment doesn't matter is the first thing. That you should just keep on, you should figure out a way to save money, to live within your means, and then you should build first you should pay off your high cost debt, because that's a guaranteed high return. If you have credit card debt that you pay 18% on, if you pay that off, that's an 18% return with no risk. That is the best investment you'll ever find. If you have student debt, 6% with no risk, that's better than most any investment you're going to find, especially in this environment. Paying off a mortgage probably doesn't make sense, because on an after-tax basis, that's going to be 1.5%. But after you put aside your emergency fund, you should invest the same amount of money every single month. And if you actually run the numbers, the more volatile the market, the more money you make over the long term, as opposed to a market that goes up and to the right the entire time. So slow and steady wins the game. Just keep doing the same thing.
And what, so I heard like some people saying that they are going to wait until the market bottoms off right now.
How are you going to know?
Exactly. Do you believe in timing of the markets?
I think there are 5 human beings in the entire world who know how to time the market. And the data is incredibly clear on this. That doesn't stop CNBC from talking about it every minute. But I can tell you, as the chairman of the Penn Endowment and someone whose friends are the chairs of the other Ivy League endowments, none of the Ivies are good at timing the market. We actually have the data. We're good at manager selection, which is something that very few people are good at, but no one is good at timing the market. And so the data and the research very clearly shows that you should not try to time the market. Just invest the same amount all the time and focus on the 3 things over which you do have control, which are diversification, minimizing fees, and minimizing taxes. And it just so happens that's what we've implemented in software.
And it's automatic.
And it's automatic. So
Yes.
You don't have to worry about doing it yourself. But by the way, you couldn't do our tax loss harvesting yourself. You just don't have enough time in a day to do it.
Yeah. Okay, so my last question for you, what learnings have you gained in this crisis, and how will it influence how you grow Wealthfront?
Well, I'm 61 years old, and I've been in the technology business since 1983, so that's 37 years. I've been through a number of these. The most important thing is just focus on delighting your customer and nothing else. If you delight your customer, the economy doesn't matter. Now, if you're in the unfortunate position that you're in the travel industry or the restaurant business, nothing you can do is going to fix it. But if you're not in an industry that's being destroyed, it's all about delighting the customer. And if you delight the customer, you're going to do just fine over the long run, as long as you're properly financed So don't sweat dilution that much. Always make sure you have cash in the bank. As my teaching partner, Mark Leslie, likes to say, cash is oxygen and oxygen is life. Don't try to be too cute about your ownership.
Okay, so I want to thank you so much. Has been a pleasure talking to you, and I'm going to pass you over to Shelpa, and she's going to do the final Q&As.
Thank you, Carol. I really
Thank you
appreciate the questions.
Thank you so much.
Thanks, Caro. All right. So how do you go about thinking about like false product market fit in the current environment that we're in, given that the market is in flux?
Well, there's the stock market, and then there's demand. Demand is not a function of the economy, other than, as I said before, some very unusual cases.
So when you think about the stock market and building like fintech products for the current market, how do you think about like false product market fit?
I look at exponential organic growth. It does not lie.
Right. Great.
Real product market fit works in good markets and bad markets.
Thank you. And then this was a question that came up earlier. Can you talk more about how Wealthfront iterated on the market in the early days? Which audience segment did you start with, and how did you iterate?
Well, we thought we were focused on delegators. We knew that we didn't have much of a chance. Our hypothesis was, that's a better way to state it, that do-it-yourselfers would not want to pay us a fee. Our experience is that about a quarter of investors are do-it-yourselfers, about 3/4 are delegators. Do-it-yourselfers are do-it-yourselfers for one of two reasons. Either they like doing it, or they don't believe any fee can be justified. So we really wanted to stay clear of them, and we wanted to build a product for delegators. And what we didn't realize was that by building a marketplace of investment managers who had been vetted using the same techniques that the Ivy League endowments use, what we were doing was really serving do-it-yourselfers, because while we gave you all of the tools, you had to choose which manager was appropriate for you, and only a do-it-yourselfer could do that. So we really screwed up, and but only through delivering a product to the market could we have figured that out. There's a limit to how much you can learn pre the delivery of product.
Great, thank you. The next question comes from Andy LaRue. How would you distinguish between a short-term spike due to the crisis and long-term behavior change?
That's a very good question. I think you have to analyze the root cause for the demand and ask yourself, is that something that's likely to continue? You know, one of the things that engineers are really big on is root causing mistakes or problems. And that whenever something goes wrong, we have a process of following the 5 whys, which is a Japanese technique to try to get at the root cause. And you can't assign blame when you do this, otherwise it doesn't work. But you literally have to ask why 5 times to try to get to the root cause of what happened. And if you're convinced after you've gotten to the root cause that something is sustainable, that's my only guess as to how you might figure that out. That would be my advice.
Okay, thank you. With that, we have 2 more questions. When you were at Benchmark, what company had the most product fit that you ever saw? What did you see, and why was it so special?
Well, actually, the company that had the best product market fit was after I retired. And I would say that was Snapchat. And the reason that I say that was the best product market fit was because it grew the fastest organically. You know, if you think about it, all great companies grow organically. When Google got started and Facebook got started and Netflix got started, you never saw advertisements from those companies. Or Uber, or Snapchat, or TikTok. Have you ever seen any TikTok ads? No. So to me, the best measure, as I've said, oh, forgive me for being boring about this, is the rate of organic growth. So we've been fortunate at Benchmark that we've been associated with a lot of really successful companies, and some of the most rapid or the fastest growing ones were things like eBay and Twitter and Snapchat and Uber.
Great, thank you. We just have one more question, which is more general for our founder community that's part of WAFFA. What advice do you have for startups that are entering industries that are adversely affected by the current state of the world, like tourism, etc.? How do founders in these industries build resilience in their business models, and how does one differentiate between temporary versus permanent behavior change?
That's a great question. Well, first of all, the data clearly shows that there's no best time to start a company. That I actually did some analysis that I followed up with over the years and found that the number of tech companies started each year that ultimately reach 100 million in revenue is incredibly constant. It's about 15 plus or minus 3. It's a relatively small number of companies. Now, many people believe, and I think this has merit, that the best time to start a company is in a horrible economy because it's much less expensive to get started, that everything costs less. The challenge is getting capital. So if you're going to start in an environment like this, you want to make sure that you have plenty of capital, cash, to see you through this environment. And the likely case is if you do well in this environment, you're going to do even better in a forgiving environment, unless it was something like helping someone find PPP loans. That's a very, very short-term and transient opportunity. But if you could figure out how to help someone plan a vacation or take a vacation in this environment, when things get more benign, it's only going to get better. So the critical thing to do, I think this is a great time to start a business as long as you can get enough fuel in the tank to be able to see it through.
Great, thank you so much, Andy. With that, we're done with our Q&A, so I'm going to hand it off to Alice to close out.